Since bonds are typically long-term debt instruments which provide periodic interest income, along with the return of principal amount with the return of the principal amount at maturity, their prices can be calculated using present value techniques, such as discounting future cash flows. The components of a bond include the par value, the principal or face value of the bond on which interest is paid. It's typically $1,000. The coupon rate, which is the annual rate of interest paid by the issuer. The coupon, the regular interest payments received by the buyer. It is calculated as the product of the coupon rate and the par value and divided by 2 if the interest is paid semi-annually. The maturity date, the expiration date of the bond on which the final coupon and the principal value is paid by the issuer. And the yield to maturity, the discount rate or the expected rate of return on the bond, which is used to determine its price. So let's say you see the following price quote for a coupon bond. The issuer is Hertz Corporation. The price, $91.50. The coupon percent is 6.35. The maturity is June 15th, 2010. The yield to maturity is 15.438. The current yield is 6.94 and the rating is B. This means that this is a B-rated bond issued by Hertz Corporation and it's selling at 91.5% of its par value, which is equivalent to $915, based on the face value of $1,000. Based on its coupon rate of 6.35, it will pay 63.50 cents in coupon interest each year until it matures on June 15, 2010. Based on its price of $915, an investor is earning a current yield of 6.94%, which is 63.5 divided by the $915 per year, and if it's held to maturity, it will have earned a yield of 15.438%. Now, how do we price bonds? Since bonds involve a combination of annuity and lump sum payments, its price is best calculated by using the following 4 steps. The first thing you want to do is lay out a cash flows on a timeline. And then you want to determine the appropriate discount rate. Next, you want to calculate the present value of the coupons and the par value. And then you add up the present values to calculate the price of the bond. Now, most corporations and government bonds pay coupons on a semi-annual basis. Additionally, some companies issue zero coupon bonds by selling them at a deep discount. To calculate the price of these bonds, the values of the inputs have to be adjusted according to the frequency of the bond. So, for example, if for semi-annual bonds, the annual coupon is divided by 2. The number of years is multiplied by 2, and the yield to maturity is divided by 2. The price of the bond can then be calculated by using the time value of money equation, a financial calculator, or a spreadsheet. Coupon bonds are also known as pure discount bonds. Zero coupon bonds are sold at a discount from face value and do not pay interest over the life of the bond. At maturity, the investor receives par value, usually $1,000. The price of the zero coupon bond is calculated merely by discounting its par value at the prevailing discount rate or yield to maturity. Additionally, you'll need to differentiate between the bond's coupon rate and its yield to maturity. This is often confusing. It is important to explain them uh, explaining that the coupon rate is set by the company at the time of issue and is fixed. Now, the yield to maturity is dependent on the market, economic, and company specific factors, therefore, it's variable. Now, the yield to maturity is an expected rate of return on the bond if held to maturity. The price that the price that is willing the price that willing buyers and sellers settle at determines the bond's yield to maturity at any given point. Thus, this changes as economic conditions and risk factors will continue to cause bond prices and the corresponding yield to maturity to change. A bond's yield to maturity can be calculated by entering the bond's coupon amount, the price, and the remaining number of coupons, and the par value into the time value of money equation or the financial calculator or the spreadsheet. Now, the other interest rate, the coupon rate. The coupon rate of the bond is set by the issuing company at the time of issue and represents the annual rate of interest that the firm is committed to pay over the life of the bond. Thus, it is the rate set at 7%. The firm is committing to pay 7% of $1,000, which is $70 per year on each bond, whether it is in a single check or two checks if it's paid semi-annually. Typically, an issuing firm gets the bond rated by a rating agency such as Standard & Poor's or Moody. Then, based on their rating and planned maturity of the bond, it sets the coupon rate to equal the expected yield as indicated in the yield book available in the capital markets at that time, and sells the bond at par value. Once issued, if the investors expect a higher yield on the bond, its price will go up and down. Its price will go down and the bond will sell below par value or a discounted bond or vice versa. Thus, the bond's yield to maturity can equal to par value, higher than the discount bond, or lower than the premium bond, lower than the premium bond coupon's rate. Another method of financing for the organization is stocks, equity. Common stock, like bonds, represents a major financing vehicle for corporations and provides holders with the opportunity to share in the future cash flows of its issuer. Unlike bonds, however, holding common stock signifies ownership in the company with no maturity date and variable periodic income. Now, ownership. As part owner of the company, common shareholders are entitled to their share in the residual profits of the company and have a claim to all assets and cash flows once the creditors, employees, suppliers, and taxes are paid off. Ownership via common stock also confers voting rights to the shareholders, allowing them to participate in the management of the company by electing the board of directors, which ultimately selects the management team that runs the company's day-to-day operations. Claims on the assets and cash flows. So you do have the right to share in the residual assets and cash flows of the issuer once all of the other stakeholders have been paid off. You have a standard right to vote, typically one vote per share provided to the shareholder to vote in the board elections and other key changes to the charter or bylaws. This standard can be altered by issuing several classes of stock. There is also non-voting stock, which is usually for a temporary period of time, or super voting rights, which provides the holder with multiple votes per share increasing the influence and the control over the company. Additionally, there's no maturity date. Common stock is considered to have an infinite life, since unlike bondholders, shareholders do not have a promised future date when uh, when they will receive their investment back. The company pay the company can pay cash dividends periodically to the shareholders out of the net income. Unlike coupon interest paid on the bond, dividends cannot be treated as a tax-deductible expense by the company. For the recipient, however, dividends are considered as taxable income. There are authorized shares. This is the maximum number of shares that the company may sell as specified by its charter. And then there are issued shares. This represents the number of shares that have already been sold by the company and are either currently available for public trading, these are outstanding shares, or held by the company for a future, such as rewarding employees. This is treasury stock. Treasury stock represents non-dividend paying, non-voting shares that have been held by the issuing firm right from the time they were first issued, or shares that have been later repurchased by the issuing firm in the market. Lastly, as owners of common stock, there is preemptive rights, which are the privileges that allow current stock shareholders to buy a fixed percentage of all future issues before they are offered to current. Let me say that again. This allows current shareholders to buy a fixed percentage of all future issues before they are offered to the general public, and they are provided to the common shareholders so as to allow them to maintain their proportional ownership of the company. Now, the stock market. Stocks are traded on two types of markets: the primary or the first sale market, where the firm first sells its stock, and the secondary, the after sale market, where previously issued shares are traded among investors themselves. The primary markets are markets where companies want to go public, are involved in selling their stock to the investor, generally with the assistance and expertise of investment banking firms. The initial public offering, or the IPO, is the first public equity issue of the firm. The prospectus is the document that provides information regarding the issuing company and the impending sale of the securities to its potential buyers. Due diligence. These are the steps taken by the investment bank to ensure that all relevant information regarding the stock issue is being disclosed prior to the sale. Firm commitment. It's the underwriting arrangement under which the issuing company is assured by getting a fixed amount of funding, since the investment banker essentially buys the entire stock issue from the company at an agreed upon price and then tries to sell the issue for a higher price. Best efforts is the arrangement whereby the investment bank pledges to give his or her best in trying to sell the shares in exchange for a small commission based on the selling price of the stock. This all occurs in the primary market. Now, the secondary market, how stocks trade. The secondary market represents a forum where common stock can be traded among investors themselves, thereby providing investors with liquidity and variety. In the United States, there are three well-known secondary markets. There is the New York Stock Exchange, the NYSE, the American Stock Exchange, the AMEX, and they are both physical trading locations with trading floors. And then there is the National Association of Security Dealers, which is the NASD, and this is a trading system. The National Association of Securities Dealers Automated Quotation System, better known as the NASDAQ, is also known as an over-the-counter market, and its registered dealers trade stock via telecommunication networks. A specialist is an elite member of the stock exchange assigned to the exclusive responsibility of maintaining an orderly market for an assigned group of stocks, for which he or she keeps records of unfilled orders awaiting execution in the limit order book. The ask price is the price that the dealer is willing to sell at. The bid price is the price that the dealer is willing to buy at. The ask bid spread is the dealer's profit or difference between the bid price and the ask price. Now, the bull market and the bear market are terms that are used to describe the stock market trends. A bull market is the label for prolonged rising stock market, coined as an analogy that a bull attacks with its horns from the bottom up. And a bear market is the label for a prolonged declining market, based on the analogy that the bear swipes its paws from the top down. Preferred stock. Preferred stock is a source of capital sold by the company, whereby they offer to pay a constant dividend to the holder for as long as the stock is outstanding. Typically, the stock has preferred stock. Let me start over. Is the source of capital sold by the companies, whereby it is offered to pay a constant dividend to the holder for as long as the stock is outstanding. Typically, the stock has infinite maturity, but some issues are sold with convertible options, in which case they can be converted either to shares of common stock at a predetermined ratio. Preferred stock owners have preferred status over common stockholders in the case of dividends and liquidation payouts. Now, they can also be issued at a cumulative or non-cumulative dividend payment term. To calculate the price of the preferred stock, we use the present value of the perpetuity equation and the annual dividend rate, being that the payments are and the required rate of return being the discounted rate. So the price of the preferred stock is equal to the annual dividend divided by the required rate. So Mid-American Utility Company's preferred stock pays an annual dividend of 8% per year on its par value of $60. If you want to earn 10% on your investment, how much would you offer the preferred stock? Well, the annual dividend is 8% times $60, which is $4.80. The price, $4.80 divided by 10% is $48. Efficient markets. An efficient market is one in which security prices are current and fair to all traders and transaction costs are minimal. There are two forms of efficiency: operational efficiency and informational efficiency. Operational efficiency concerns the speed and accuracy with which trades are processed and the ease with which the investing public can assess the best available prices. The New York Stock Exchange, with the super designated order turnaround, or super DOT, computer system, and the NASDAQ with its small order execution system, can match buyers and sellers very efficiently at the best available price. They are therefore definitely very operationally efficient. Informational efficiency is the speed and accuracy with which information is reflected in the available price for trading. In an information efficient market, securities would always trade at their fair or equilibrium value. Since information is fairly diverse, financial economists have come up with three versions of efficient markets from an informational perspective: weak form, semi strong form, and strong form. These three forms make up what is known as the efficient market hypothesis. Weak form efficient markets are those in which the current prices reflect the price history and the trading volume of the stock. Thus, charting other technical strategies would be useless if the markets are truly weak form efficient. Semi-strong form efficient markets are those in which the current prices readily do not reflect current prices readily reflect not only the price and the volume information of the stock, but all available relevant public information as well. It is therefore futile to try to exploit publicly available news or financial statement information to routinely outperform the market. Strong form efficient markets are those in which current prices reflect the price and the volume history of the stock, all publicly available information, and even all private information. It implies that all information is readily embedded in the price, and hence there is no advantage to using insider information to routinely outperform the market. And despite the testing of market efficiency, the jury is still out on regarding the question of whether or not markets are truly weak, semi-strong efficient. A long evidence points out that markets are fairly semi-strong efficient, and there are exceptions by making this result inconclusive. Most investments are such that one is not sure about the performance at a future date. If an outcome is known with certainty, such as the value of a treasury bill at maturity, is considered to be riskless. On the other hand, if an investment has the potential for loss, this would be considered risky. Hence, risk can be defined as a measure of uncertainty in a set of potential outcomes for an event in which there is a chance for some loss. It is important to measure and analyze the risk potential of an investment so as to make an informed decision. When faced with an investment option having varying risk return profiles, it is important to keep the following two rules in mind. Number one, the investment rules. The investment rule number one: if two investments have the same expected return and different levels of risk, the investment with the lower risk is preferred. Investment rule number two: if two investments have the same level of risk and different expected returns, the investment with the higher expected return is preferred. Since investors aim to maximize return and minimize risk, it is obvious that the investment with the higher expected return and the lower level of risk is preferred over another asset. Typically, though, if one asset has a higher expected return over the other asset, this also has a higher risk estimate. estimate. In such a case, the choice is not clear cut, and the investor's tolerance for an attitude towards risk matters. The following principle of diversification or spreading out risk by holding a portfolio of assets rather than just one or two securities would serve investors well in a world fraught with uncertainty and risk. Diversification is the spreading of wealth over a variety of investment opportunities so as to eliminate some risk. By dividing up one's investments across many low correlated assets, companies, industries, and countries, it is possible to considerably reduce one's exposure to risk. The benefits of diversification are best realized when combining stocks that are not perfectly positively correlated with one another. The more negative correlated a stock is to one another in an investment portfolio, the greater the greater will the reduction of risk be achieved by adding to its portfolio. Now, the total risk of an investment can be broken down into two parts: unsystematic or diversified risk, and systematic or non diversifiable risk. Unsystematic risk or company specific risk can be diversified away by efficient portfolio formation and diversification into investments that have a low correlation with each other. Examples include product problems, problems that plague individual companies or sectors. Systematic risk or market risk is non-diversifiable risk in that it permeates throughout the system and affects everyone, albeit some more than others. For example, recession and inflation. A well-diversified portfolio is one whose unsystematic risk has been completely eliminated. For example, large mutual funds.